All right, let's get this party started. So, esteemed panel, obviously a few things have changed in the world over the last few weeks. And, you know, that leads us to the obvious question of what's next, right? Where are we going next? And lots of ideas floating around, lots of uncertainty. So I wanted to start with what's the biggest thing, risk or opportunity, sort of like event or metric that you're watching from here after what's happened, after Russia invading Ukraine and all the economic impacts that that's had? What is the thing that you're watching to try and help you understand how the world is changing or what direction things are going from here? Is there a financial metric? Is it a politics thing? Like, what is it that you're watching most right now? Eric?
Well, I mean, two things I'm watching are two things that I mentioned that are not things, I mean, they're things I keep an eye on, but they're not things that I'm writing about per se. You know, I think the oil price gives us in the short run at least, I think it's probably a good guide, as good a guide as anything to whether whether the sanctions are working. Because, I mean, they're not really sanctioning oil. I mean, Canada will, the U.S. will, Europe's making noises. I'm skeptical about it because I just don't know how they'd replace it, honestly. But there are, as I said yesterday, these sort of unofficial sanctions, in that there's certain ports that simply are refusing to load oil. The other thing I think we need to keep an eye on, and I'm not going to pretend it's something I normally pay much attention to, and I alluded to yesterday, and that's the wheat price, and I use wheat just because it's a freely and commonly traded futures vehicle where it's not that hard to get quotes, so it's not hard to follow it, and it's more, you know, that's something that'll give us a measure of future inflation impacts. Although it's not like for your average North American or European citizen, it's not like that's a huge part of their daily budget. But to me, it's more something that we need to watch, because, like I said in the talk yesterday, if you go back to the Arab Spring was pretty much a direct result of massive food inflation in 2014, and that in turn was pretty much a direct result of the first time Putin went in and took over the Donbass, and the Black Sea effectively got closed for 3 or 4 months, and there was no wheat shipments. Well, we're there again, so I think you got to be watching for political ramifications, and, you know, basically another Arab Spring, and it doesn't have to be in northern Africa. It could be anywhere where food prices and fuel prices, those are two huge items for most people in developing countries. So, you know, this thing, there could be some not very nice knock-on effects, I'm afraid.
Yes. Peter, thoughts?
Well, I'm glad that I have something a little bit different to say from Eric. And you didn't steal my thunder completely. But similar, I did talk a lot about this in my talk, and that was inflation. And so for me, inflation is sort of the one big thing to watch. I did say that I think it's going to be the defining feature of the economic and the investment environment for probably the rest of the decade. And so I'm watching that closely. I think that, official numbers are very much understated. I think that they're purposely understated, and I think that they'll continue to be understated. And I think that for multiple reasons, I'm not going to go back into all of that, but I think that the officials that are understating are going to continue to be surprised. And so for me, inflation is a big one. I think that because it impacts everyone, and because it impacts everything across the economy, and I think that because it's something that, as I also mentioned, so many people do not have the experience. I mean, based on the hair color in this room, I think that a lot of the people here do have the experience with some inflation. Many don't. And because of that, that's going to be a new thing for people. It'll take a while to sink in. If it hasn't sunk in, I think the last couple of weeks have done a lot to work towards that. And so it's kind of an all-inclusive number. It tells us everything about kind of what's going on and where we're headed. So inflation's a really big one. And then the other one, although I'm a silver bull, gold is the other big one. I think gold is very representative of what's happening with money supply and the loss of control. And so certainly continue to be a silver bull. It doesn't change that, but silver follows gold. And so I like to watch what's happening with the gold price, the reaction, the trend. And I would certainly have to agree with what Jordan was saying earlier. I think this is really the beginning of, at least for me, the second phase of a really big precious metals bull market. Gold's going to lead the way and silver will follow along for the ride.
Jay?
Well, certainly supply chain issues, yes, Eric touched on it.
Can you pull your mic a little closer?
What?
Just pull the whole thing closer.
Closer?
There you go.
Okay.
Thanks.
I was saying supply chain issues that started with COVID now could be exacerbated, looks like they will be, by this war. David Stockman, I played a clip from my radio show in my talk. He talked about how a great deal of supplies are coming from China and that part of the world across Russia into Europe, and that people are not putting their goods on the trains, on the rails to get across Russia for obvious political reasons. Shipping prices are going up dramatically beyond where they were already elevated after COVID. So supply chain issues affect everything. Oil price, the disruptions of oil supplies, or what's going on now, certainly is going to ripple through into inflation. Of course, if the Fed could, if central banks could stop printing money to try to outrun the deflationary impact of all this debt, it wouldn't be a problem, but we just have massive unemployment. And what I really think of really trying to watch closely is the T-bill, the T-bond market, the interest rates, because here I think we had a 7.9 print on CPI this week, and so a 2%, less than 2, I guess we ran up to 2% on the 10-year Treasury. I mean, it just doesn't compute. What's going to happen? I mean, what should happen is that we should go back to 1979 and stop the money printing and pay the price now instead of a bigger price later, but that's not going to happen. So we will continue to, no doubt. I mean, watch for the breakdown. The equity market's starting to come under a lot of pressure now, it seems, with just a quarter point rise. It should be much, much higher. And unless you really can buy the idea that we're going to have declining prices somehow, if you can see your way to that, I presented that viewpoint in my presentation, that with all of the massive amounts of debt, interest rates just can't rise very high because the system can't take it. Mm-hmm. And so I think I'm watching interest rates as much as anything, because inflation rates, I definitely agree, they are understated for political reasons. Everybody does it, I think, in government to try to make themselves look good. So the equity markets are starting to show some trouble, some difficulties with these with 2% Treasury rates. I mean, what in the world? And so every cycle we've tried to quote unquote fix it by doing the same thing, doubling down essentially. That's just all they know to do. That's the Keynesian idea that you can just print your way out and spend your way out. And I think that we're nearing the end of the fiat money system, honestly. I don't know what will take its place, but I don't see how it can go on much further. So to me, it's T-bills, T-bonds, and interest rates in this environment. That's what I'm watching really, really carefully.
Yeah, I would. Can everybody hear me?
Yep.
You can pull it closer if you want.
I would watch things like gold against the CRB, gold against copper, maybe silver against the CRB. Watch these kinds of intermarket relationships, especially the gold against copper, gold against commodities, because when we see strong outperformance there, that's going to signal the coming recession, in addition to the yield curve inverting, which should happen in the next couple months. And then also watching silver, because silver will outperform for sharply, but for a limited period of time, And then at some point when silver starts to underperform gold, we'll probably be in a recession at that point, so that'll be a year away. But I think when that happens, that could be a warning where inflation is rolling over. We're getting into the worst part of the recession, and then at that point, that would be the point to take a lot of profits in precious metals.
That's because of its industrial component. Right? That's sort of your basis.
Well, I was looking at a potential analog is the mid 70s in that recession, and gold it was inversely correlated with the stock market and the economy the whole way through. Gold actually peaked at the end. The gold stocks, they peaked a little bit before gold, and silver actually peaked with the CRB like pretty early. I want to say like a third or a little bit more that much through the recession. So if we follow that template, that tells us that precious metals and commodities will do very well into the beginning of the recession. But I'm getting a little bit ahead of where we are right now. But it's just, at first silver should really outperform, but later on it would be a warning sign when silver and the gold stocks start to underperform gold a little bit. That would be a warning sign, at least for our sector, but we're not close to that point yet. But so at least at the beginning, here and now, like I said at the beginning, gold against like copper, gold against commodities.
But Jordan, of course, it was the Paul Volcker that crushed the gold market. And I like to remind ourselves that we had a 17.5% mortgage in 1981. There's no way that the Fed can really fix it this time and give us another several generations of growth, and setting the stage properly again and reducing the debt. And at that time, we had 33% of GDP, debt to GDP. Now it's 130%. So the idea that I just think there's nothing left except to accelerate the printing of money faster and faster, more and more, to debase the currency. That's why I think that ultimately the dollar is going to, and the whole dollar-based system is likely to come under some pressure, some kind of reorganization.
I completely agree. And I think, where we are is we're at an early 1970s moment where all the things that gold bugs have been talking about, people like us for years and years, we're going to see that in the next 10, 15 years where it's really going to accelerate. Gold is it's easily going to go past 10,000, not in the next couple of years, but it will easily move to those levels. It's just simple math and based on historical valuations. And then my point is it's really the inflection point is now with the way gold has started to move, breaking 1900. When it breaks 2100, then it's really going to move.
Okay. This is what an economist call the na-na-ni-na-na moment. That's the name of the theory.
The technical name.
Yeah, the technical name.
Right.
I'm just so excited when Jordan gets excited because we have all been doing the gold bug thing for a long time, but then Jordan joins in and you're like, oh, okay, I feel validated.
Maybe it's a contrary indicator, but probably not.
The only thing I might add to the conversation is looking at volatility. I think there's a lot of snowball risk, right? And I don't know how this is going to play out, but one of the big questions that's floating out there for me is how this turns, if and what kind of recession this turns into, right? Do we get to stagflation? Do we get to a short recession? Do we get to, and that will impact the base metals side of what we do, right? I think the gold argument is a solid one, whether you try and play a recession or just ride it out because gold, has sharp bottoms in moments like that. That's one's own decision. But I think the base metal side of a portfolio, you have to pay a lot of attention to the recession risk and whether that's going to be a drawn out thing, whether that's going to be a sudden thing. And so watching volatility, the big stock market crashes and corrections that we've had in recent decades have been all to do with leveraged collateral situations. Commodities it acts as collateral, and so do these crazy price spikes, they can certainly play a role in starting a big volatility move. And of course, we've seen volatility increase. The VIX is at 35 instead of at 15, like it has been for a long time. 35 is still a manageable number, but volatility is certainly something that I'm watching to get us a sense of how quickly a recession might be coming, or what form that recession might take, because unfortunately, inflation numbers are a bit backwards looking, and interest rates don't exactly move. This one will try and keep this answer short, but
Good luck with that.
I know, right? Do rate hikes impact inflation anymore? Like, I'd say a few weeks ago, we might have argued that there was a more likely impact on inflation from the Federal Reserve raising rates. How do we feel about that in 2022? Because like that was what we were all obsessed with 3 weeks ago.
Generally speaking, even if you go back to classic economics that all gold bugs hate, I won't mention the he who must not be named, because Jay's sitting here and he'll get all really angry and stuff. but generally speaking, cost push, like there's demand pull, there's cost push. There's 2 to 3 different types of inflation. Almost all of what we're seeing right now is cost push. It's because of wheat going, oil going, natural gas going, you name it, lumber, all kinds of things, supply chain issues. So really raising rates doesn't do anything. Like raising rates is not going to get rid of cost push inflation. The only way on a broad basis that raising rates is effective at decelerating an inflation curve, and nobody in the Fed or Washington or Ottawa is going to want to phrase it this way, but it's fairly simple. You raise rates enough to decrease aggregate demand, which is what an economist calls a recession. So yes, if you jack rates enough and create a recession, you'll probably moderate the costs.
Right.
You won't get elected next year, but you'll moderate the costs. So the question is, you can make an argument that doesn't make sense to do that. I mean, do we, at the end of the day, do we really care? I mean, there's reasons why we do. People are losing purchasing power, I get that. But, really, I really sympathize with people in central banks right now. They're in a very, very, very tough place. I don't know how they work their way out of this.
Thoughts to add from down the line?
I guess I'll go. So, I mean, I feel almost like I'm not answering the question, but I can't see, very much like Jay said, I can't see rates being raised enough. They don't have the room for it. The impact is too big, the debt's too big, their hands are tied, and I think to some extent they need to try and look tough at some point. And so, yes, maybe they will start, but I see them backing off so quickly that at that point all bets are off. And I think that it's almost like the gold market's going to call their bluff, and that'll be it. It'll take off. I mean, and if I can kind of go back for a second to the talk about recession. I think realistically, like Jordan was saying, that's in the cards, probably not necessarily all that far off. And I think that that's when we're going to see something that's been floating around in a somewhat disguised way. It'll become, the disguise will come off, but we're going to see this whole modern monetary thing really take center stage. It'll be widely accepted, it'll be widely praised, it'll be the excuse to just ramp up the printing press, sort of a whole other more order of magnitude, and that's going to be sort of the start to the start of the end, and so to speak. Those are my thoughts.
This was a much more positive conversation on the last question. Jay?
Bring us down.
What's that?
Bring us in for landing, Jay.
Interest rates.
Interest rates and inflation.
Impact.
I mean, I was asking for short answers. Nobody's listened yet, but you can feel free
You can say yes or no.
No, I think it's very difficult to. So we have, I think more than 50% of Americans are living one paycheck to the next. They don't have any savings. they're getting wiped out by this interest. I mean, yes, there are raises, there certainly was a push to get money in the hands of common folks. That's the Democrat Party, and send money out to the masses with COVID and whatever other excuse you could find. And it did pop things up. We had a sugar high, and the economy was growing, but it seems to be coming down. The projections I'm seeing really suggest that we could be nearing a recession very quickly. I don't think there's anything that can be done interest rate wise unless you really want to fix it, and nobody would tolerate that politically. I think to talk about Arab Springs, I don't know. We saw a couple of summers ago something that looked kind of like some kind of a spring, when buildings were burning all over America and people were, trashing cities and shooting policemen and stuff like that. I don't know if you have masses of people that can't put food on their tables, as Eric was suggesting. That's when you have real trouble. And I don't see any real answer to it. I'm sorry I can't be more positive. Well, if I were, then I couldn't be a gold bug. Huh? No, I could be. I would love to not. I would love not to spend my time necessarily looking for gold in the ground and following companies that do that. But to me, it's just the fact that we have what I think is a Ponzi system. It's a Ponzi system. The monetary system is based on faith. There's nothing underneath it. And we've seen when you take the gold away from the constricting, from holding down the ability of politicians to do what they'll do, to do what they want to do, to give things away in exchange for votes, we're seeing what happens. And I don't think that I think the system just has to play out, and I agree that monetary MMT is likely to come because I think it was the Federal Reserve economist that I talked about in my speech was that he's a real deflationist, by the way, and he was asked, "Is there any way that you could see a runaway inflation?" And he said, "Yes, if the Federal Reserve became the spender of last resort instead of the lender of last resort." And then he said, "I don't think it's going to happen this year. I don't think it's going to happen as long as Powell is the chairman." And he left it go at that. So to me, I think the handwriting is on the wall. You get rid of all the restrictions, basically get rid of an independent Fed, and you can just send money to people or tax them if you need to bring it back out of the system. But I mean, there's serious people now that are talking about it, and I think it's one step away from the next Federal Reserve chairman, especially if the Democrats remain in power. But that's what I think. But in terms of interest rates' ability to curb inflation now, in the short run, I don't think so. Did I answer?
That was the short answer.
That was the short answer.
The last
Okay,
sentence.
I have more.
Jordan, do you have anything to add?
Well, I think
Get the long version over a drink.
I think raising interest rates works more to dampen credit growth and bank lending and those types of things. But I think the Fed, really high prices cause lower demand at some point. So I don't think raising rates right now is really would help that much. They obviously want to get inflation down, but that would be my view. Here and now, it doesn't seem like it will be as effective because we're at a point where bank lending and credit growth in general, because of all the debt that's out there, because that's been the policy over and over again, and the impact and the so-called positive effects and the growth has been lower and lower each cycle, that the next cycle, I would disagree with Jay. I don't think left or right, I don't think it matters. I think whoever gets in power, the government, through the Federal Reserve and printing of money, they will be directing it at, various industries to try and stimulate the economy, because the, banks and corporations are just, they're not investing in the future, or they're not lending out as much money as before. So the only way you're going to get growth and keep people employed is with the government or with the Fed through MMT, all that stuff. But obviously, that's going to be hugely inflationary, as we saw in the amidst COVID and all the money that they directly gave to people. I mean, look how much inflation that caused just in 1 year. So we will see something similar to that, but on a smaller scale, but steadily. That's going to have to drive the next expansion in the next couple of years, and that will be hugely inflationary. And I think that I know we're getting too far ahead, but I think that expansion you'd probably see base metals, silver would probably outperform gold.
Interesting. Okay, let's bring this back to metals, because we could wave our arms a lot and they would fall off if I let this keep going. We'll start at Jordan, let that end of the table go first. We've had some crazy commodity price moves in the last 2 weeks, obviously. What is the metal or commodity? I mean, I can expand it outside of metals. What is the commodity that you think has the biggest potential for gain over 2022 from here? And which do you think is the riskiest right at this moment over 2022? And I know that's it's kind of a crazy moment to ask that question, but that also makes it perhaps interesting.
Yeah, I mean, I would say best potential, I'd say silver or gold, probably silver. But it's one thing I'm trying to figure out and wrestling with, how much can silver outperform gold? I don't think it's going to be as much as people want, but nevertheless, I would still, for this year, I'd still say silver. As far as what's the riskiest, maybe oil, maybe copper. I'd have to do more research, but that would be one of those would be my guess. Just because they're very sensitive to economic demand. And at some point, and we got a long way to go this year, but I think by the end of the year, I think those commodities will probably top out.
Fair enough. Okay.
Yeah, I expect the debasement of the currency to go on, and probably as soon as there starts to be some real dramatic declines in the equity markets for the Fed to give up on tightening, and then I think the debasing of the currency, and then it's gold, and probably I agree with Jordan that silver will outperform gold. Now that both of them I think are in a bull market, and when we're in a bull market for the metals, the precious metals, silver usually outperforms, and on the downside it does worse. And then probably the biggest risk, I would agree, probably is oil at this stage, because who knows if somehow things get resolved somewhat peacefully in the future, then maybe oil can come down a lot. Certainly could see more production from the United States, but the current administration certainly isn't inclined to do that. So they want to go green and let everybody else pollute the environment. So you Canadians, sorry, we're not going to buy your oil because we're good citizens. We don't pollute the world. All right, you guys. You guys are the guys. You create that sick, terrible stuff.
Fair weather.
So I'll be 3 for 3 on silver in terms of potential for this year. And when it comes to, I think, gold will have perhaps a move that's more noted. But if you get to the end of the year and you do the percentage gains, I think silver will probably carry it. And on the downside, I'd have to say nickel right now, just because of the massive move that it's made in the last week or day or two, and clearly an industrial metal, and clearly something that a much too big of a move that could be sustained. It's just completely unrealistic, and so that would be mine.
I'm probably going to go with gold on the positive side, and the simple reason for it really is the last 2 weeks, gold, startlingly, for someone who has been smacked upside the head by it numerous times in his career, has actually weirdly done what it was supposed to do. It's kind of like, whoa, okay, everything's going for shit and gold's going up. Who knew that would happen? Didn't work the last 4 times, but it does in fact appear to be working this time. And I think it's clearly drawing in generalist money. There are people going, I don't know what I'm going to do with this stuff, but I accept the fact it's a store of value and it's working. So yeah, maybe I'll buy more of that. And the kind of people saying that right now are people with enormously larger checkbooks than any of us have. So I think that demand will help underpin it. The two metals, Peter's right. Nickel obviously was, who knows what the nickel price is. Even nickel guys don't know what the nickel price is right now. But two that I admit, I mean, I like them, but I'm honestly a bit surprised, a little surprised at how well they traded, and that's both iron ore and zinc. I mean, I like zinc, but even guys I know that are zinc developers and zinc miners everyone's kind of bemused about the fact it's sitting at $1.80. Yeah. And I think a lot of it is sort of the smelter stuff I was talking about in my talk yesterday. The problem is not shortage of concentrate, it's shortage of smelter capacity to turn it into metal. Iron ore doesn't really have those issues, and there's been an enormous increase in production of iron ore. I mean, to me, for iron ore to stay at these levels, and maybe this is what will happen. I mean, the market has to be presuming China is going to be spending enormous amounts of money on infrastructure, like year in and year out going forward. Maybe they will, but I mean, it seems the last couple of years like Xi was trying to kind of edge away from that whole just throw money at it. Let's try to rationalize the economy a bit. So I find it a bit surprising iron ore is trading as well as it is, because it's all-time highs, like by a mile. Like, it's crazy.
I also had nickel and zinc as my two downside ones. Like Eric was saying, the zinc price move has been confusing. It doesn't have specific. There's not a lot of fundamental reason why it's responding to this crisis the way that it is. Yeah. There's some reason, like Eric says, there's knock-on reason, but it's a bit overstated in its gains, and zinc likes to be sort of a pessimistic price in general, so I feel like it will revert to its natural pessimistic state by the end of the year, so I think that there's some downside built in there. Thermal coal is trading higher than met coal right now. I mean, I think that there's a strong future for thermal coal right now, because if Europe's going to try and move away from Russian energy, then there is a strong future for thermal coal. But for it to be trading at $500 is pretty crazy. So that's a volatile one. You know, is it going to drop off next week? Is it going to rebound again before the end of the year? I don't really know, like, in this arbitrary time frame that I created, what's, you know, going to be the worst performer by December 31st. I don't know if it's going to fit to that pattern.
Yeah. But yeah, thermal above met is insane. It doesn't make any sense.
There's some strange things going on there. So I do think that it's one to pay attention to. And on the upside, I certainly think gold is going to do well. It's interesting that I heard a couple comments about oil being, one of the potential biggest downsides. I mean, there's people out there talking quite openly about $200 oil, so that suggests there's a lot of people out there who actually think the opposite. I don't think I would put it in either biggest gainer or biggest loser category, but I certainly wouldn't assume either way. There's too much unknown about how these global energy flows are transforming right now. On the energy side, though, I would put uranium out there. I do think that there's some pretty significant forces in the uranium market right now. All of this stuff about... So Russia controls more than half of the world's ability to turn yellowcake into nuclear fuel. And that's important because nuclear power plants don't burn yellowcake, they burn nuclear fuel. And it takes several years for them to turn the yellowcake that they buy into the fuel that they specifically need in the format for their utilities, for their reactors. So I think that this Russian situation will probably pull forward uranium buying. Contracting had already started to pick up, and I think it's going to pick up more because utilities are going to start freaking out about their ability to generate specifically the fuel that they need for their utility. So I was already bullish on uranium, and I actually think that this is going to pull uranium, the uranium market forward faster. So I actually am pretty bullish on uranium. And I'm going to throw fertilizers out there too. Russia and Ukraine are both really important in the fertilizer market, like really important in the fertilizer market. And everything we're talking about with Arab Springs and food uncertainty and food cost inflation, fertilizers only becomes more important there. And all of a sudden we've cut out a huge fertilizer producer. So I think fertilizer prices have responded. And they had already moved a bunch in the previous year, so it's a bit hard to understand how much more upside there is, but that's because we're in uncharted waters. But I do think that there is a spike ahead for fertilizer prices of who knows how long it'll last. Okay, so we're in this crazy market. The recession might be around the corner. It might be a little bit farther down the road. Gold is going to go to the moon. All these other prices are going to go either to the moon or back down to the basement. We don't know, so, I'm glad we figured a lot of things out here. In that context, juniors versus seniors in the metals space, right? Like, we haven't seen a lot of love yet for the juniors. They've been getting a bit of reflected love from these metal price moves, but certainly not the kind that those of us with portfolios overflowing with junior explorers might want to see. What's our view on that? Like, if gold does go up, obviously the convention is that, you generalists rotate in, they put the money into the seniors do well, they release some capital, and that trickles down into the juniors, and then the juniors rise later in the cycle. If we're entering into a recession or in the face of all of this uncertainty, how are we feeling about approaching it from a juniors versus seniors perspective?
Yeah, I still sort of agree with the whole, trickle down theory, for lack of a better name, where, it starts with the majors, where obviously if whatever metal they're producing doubles, it goes to their bottom line if they're not hedged immediately. It takes a while for that to move down the food chain. I think it does. I mean, I think with some of the comments that, that I've made and the other panelists have made, to me, it kind of speaks to being, if you're further down the food chain, I've got a little more comfort on the gold side, simply because I'm not expecting a really, if we went into a recession, I don't think that would necessarily hurt the gold price that much. It might not hurt it at all. Actually, gold might actually go up in those circumstances. I think if somebody's generating very good exploration results, that's going to put a decent cushion on it. Most of the explorers, though we don't necessarily love the prices they're at, they haven't had any trouble raising money, by and large. I mean, most of them are pretty well funded. So, and that's something you're always worried about. If you think there's going to be a recession, juniors live and die by the financing they can do. There's a lot of people on the list that I follow and own. They've got a couple of years cash, so that's not really a big problem. I think if you've got a story that's generating sufficiently good results and has a project that allows it to generate, a fairly continuous stream of good results, and it's, either because of where it is, they got like a Visa or a Pan Globe or a company like that. I'm not that worried about them. If there's a recession, is the copper price going to go down? Yeah. Would that weaken something like, say, Pan Global? Probably. Would I sell it? No. I mean, if I think Company X has got something that's going to be a mine, I'm not going to be freaking out if the price drops by 20% or 30% somewhere along the line. Like, welcome to mining. That's how it is, folks. But yeah, I just say, I think really early stage stuff you got to be a little more careful. But I think as long as they've got the funding, and I know the news flow is going to be there, I'm not going to be that spooked by it, I don't think.
Here?
So I don't have a lot to add to what Eric said. I agree with most of that. The only thing I would say is, certainly I would, let's say given recession risk and all of that, maybe give some additional weight to gold. Because of that, that'll resist better. And then when it comes to the juniors, if anything, yes, for sure, I also see the trickle down. But when it comes to juniors, I think that's when you'll start to see where the quality will set itself apart. It'll have the ability to hold itself up a little bit better than probably some of the medium or weaker groups or competitors. But that's going to be a bit of a temporary thing anyways, probably a question of months or a year and a half, and then we'll be back off to the races. And so if you like what you own and you think that they're good cash-wise and all of that, I don't think that it'll be a reason to get rid of them. I don't think the pressure will last long enough to move on.
Yeah, I think I definitely agree with Eric on the funding aspect of it. Those of us who have been around these cycles many times know how painful it is when the juniors can't raise money and their shares drift lower and lower. But right now, in spite of the fact that the gold share market hasn't really done that much, it's amazing how many of these, the company will go out and say, we're going to raise $10 million, and 2 days later they're raising 13. I mean, it happens I get many of the things that I'm following, that's happening all the time. And that's, to me, it just says there is an appetite for gold and for gold projects. And I think that will only grow as the equity market declines. I think people will be looking for people that aren't gold bugs, people who could care less, who buy widgets or whatever, they want to make money. So they'll go into gold. And the trickle-down thing, I think we haven't, the major mining companies have really been seemingly much more disciplined so far, but when there's a frenzy, if there's a frenzy in the gold market, which I suspect if my friend here on the left is right about the gold price, 10,000, I think there's going to be some kind of a frenzy, then I think you're going to see a lot of M&A and money coming down the market. And little guys that shouldn't be getting anything are probably going to get, be way overpriced. But I think, yeah, and definitely gold over silver if we head into a recession, for sure. Because, well, first of all, gold, and if you look at gold, really hasn't done that much compared to the equity markets. The money has not flown in, not going in. The commodities are ahead of gold at this stage, pretty much, I think. So I think gold's the best defensive play, and cash. If you really think we're going to see stock market prices collapsing, and might be good to have some cash around too, to pick some up on the cheap eventually.
I think the juniors will start to outperform when we see a weekly close above 2,100. I mean, 1,900 was extremely significant. Gold has blown through that, and I'm just rounding up. I mean, I think the previous high is 2089 intraday, so let's just say if we get a weekly close above 2,100, that should be the point when juniors as a whole start really outperforming the seniors. So I don't think, I mean, I understand the question, but I don't think this, and even though there's recession risk looming, I don't think this is the time to get defensive. I think it's actually, with respect to precious metals, I think it's a time to be aggressive, and I don't think I've ever said that before. But this is,
He's never said that before.
This is the time to get aggressive.
There it is.
Amazing.
Where's Jordan? What have you done with him?
What's he drinking?
Yeah, it's interesting. The question came in part because, I get a lot of questions in my inbox, as I'm sure all of you do. And I've been seeing this specific question quite a bit in the last few months. Okay, gold's going, why isn't the junior, when are they going to go? Is the game over?
Gwen, sorry to interrupt. Just we've seen this before. I mean, this is what happens. Before there's a big move, money usually goes into the seniors or a senior or two and gold itself. And before this war, I mean, right before it, gold was outperforming, GLD was outperforming, Newmont was really outperforming, a couple other stocks are outperforming. So that there was evidence of generalist money moving in there. And that's just, because I got a similar question a couple days ago, but that's, and I got the same question, the last time as well. How come the juniors are lagging? But that's what happens. But I mean, if I'm right, which I think I'm going to be, you're not gonna have to worry about that. If we get a big run, which gold is set up for, the juniors are gonna, you guys know how these stocks can move. I mean, they can move 50% in 3 or 4 weeks.
Yeah.
Hours.
And
Minutes?
And the seniors, I mean, because if you look at these bull cycles, the seniors make most of their move at the very beginning of the cycle. Like if you go back to 2009 or end of 2008 to 2000, the seniors had made 95% of their gains in the first 6 or 9 months, and then they did nothing. So, I mean, if you own if you're going to own seniors for a long time, at some point, a long time through the cycle, at some point you're going to be getting antsy when you see these juniors moving and the seniors are barely doing anything because they already moved a lot.
Fair enough. We have a few minutes left, but this has been a great conversation. I think I might cap it off here, unless any of you guys have burning questions that you think we should address while we're here. Otherwise, we could say thank you all so much for coming, for your attention, for your interest, and I'm supposed to pull something out of a. Oh, so there's a question in the audience.
Yes.
Up and down, and no one really knows what's happening with it. But cobalt and 5 or 6 others, all the way down to the Williams Highway, magnesium, and there's a whole fleet of energy metals. So number one, they could be on your great opportunity list. They could also be on your high volatility list and risk list. So rather than just
I'm happy to start there. I mean, you mentioned some of the, part of your question captured part of my answer, which is I can't pretend that I have the ability to keep up with all of those markets, especially because a bunch of them are so difficult to keep up with, even if it were your full-time job. Like, I can't keep up with magnesium while I'm also trying to understand all of the other things that are going on. So that's just my own problem. Like, that's my capacity limit. I'm a strong believer in the green energy revolution, like very strong believer in it, and the fact that it is a paradigm shift for metals demand. Since it takes dedicated focus to understand, like you say, even lithium, which is a big market that gets a lot of attention, but it takes a lot of focused attention to figure out that market. I am happy to have exposure to that revolution in the ways that I know about clearly, which is nickel and copper foremost. And then one of the reasons that I've been buying a phosphate company lately is because I also believe that Tesla's moving away from lithium, moving towards lithium iron phosphate batteries because it is specifically worried about not being able to get enough nickel and cobalt, and so phosphate demand is going up for that reason. So like there's certain areas that I understand and that I will invest in specifically, and other than that, I mean, I own some energy metal ETFs because I can't try and figure out cobalt and magnesium and the tiny metals on a day-to-day basis. I'm sure it's incredibly interesting, and I'm sure there's a lot of opportunity there, but I'm just not the person to try and answer it all. Anybody else?
Just a quick follow-up, if I may. The other sort of void in covering the private investors forum, that's what you're looking at, is the whole energy sector, not just oil, but from lithium and nickel and manganese and so on. There's another sort of out of left field, and that's crypto.
Mm-hmm.
What's happening with crypto?
It's a Ponzi scheme.
These days it's sideways, so.
What did Eric say?
No, I think it's a Ponzi scheme. That's my answer. I mean,
Distraction.
Scary, because the next generation, the millennials, are actually getting into crypto.
Yep.
It's one of their investment strategies.
my son trades crypto day in and day out. He thinks it's a Ponzi scheme. Like I'm not being facetious. I'm like he's going like, well, yeah, it's a great thing to trade, but yeah, like duh, it's a Ponzi scheme. But like, who cares?
And I mean, the tech bubble, like, what was it? Like, there's always moments, there's always things at different moments that work really well for a time, and that I'm sure if you want to sort of arm wave out, the younger investor crowd might latch onto because it's the exciting thing, and that's what high-risk younger investors are going to do. I really like looking at, I am neither for nor against cryptos. I don't know enough about them. They are an alternative thing that's happening. They've engaged a lot of new investors in the market, which is good because people at some point have to start understanding how to invest if they want to make their money into more than just what it is. But right now, crypto is totally sideways and gold is going through the roof. So I think that's a pretty interesting moment because for the last 5 years, every time we have a conference, somebody says, but isn't crypto the new safe haven?
Apparently not.
I mean, crypto has, if you track crypto since 2011, its biggest moves were when the stock market had its best moves as well. So crypto, it's moved like a tech stock the entire time. And every time in the last 5 years it's been going up and gold hasn't been performing well, people were complaining about it. But I don't think crypto is a competitor to gold. It hasn't taken anything away from gold. And now the fundamentals are there for gold as well as the technicals, and we're going to see gold's going to fly, and a lot of people are going to take their crypto profits and go back into gold and silver, I think. But maybe crypto at some point in the future will have another bull market. Maybe when after the recession and the stock market recovers, that's when crypto will probably rebound again. But I wouldn't touch it right now.
There you go.
But I'm just saying, sorry to interrupt, sir. I'm just saying the perception is wrong because it's been trading with the tech stocks, and it hasn't been, I mean, fiat currencies don't have like 90% or 80% declines in that kind of volatility. So it's kind of been like mismarketed, I think. But it will be really interesting to see what happens over the coming years.
Actually, I wanted to kind of chime in a little bit and talk about how in the last sort of few weeks, maybe even months or two, it's true that the cryptos, especially, let's say the Bitcoin especially, that everybody knows, the king of crypto and all of that, has not performed all that well. Gold has. Gold's been the haven when all of this happened in Eastern Europe the last few weeks. But what I find interesting is that a data point that I saw a couple of days ago was that the two gold-backed cryptos, the two largest gold-backed cryptos, I don't even remember their names, added up to $1 billion of market cap. And so, to me, what that's saying is that the generation that's comfortable with crypto may not be quite comfortable with gold in its various investment forms yet, but they are comfortable with gold-backed crypto. Mm-hmm. So I really found that interesting in terms of that the way that kind of meshes together, and that they've maybe not dumped crypto, but the crypto hasn't moved, and the gold-backed crypto has. So I'm just kind of putting that out there.